On June 23rd, that is next week, Tuesday, investors will be holding their breath as they wait for that bell from Nairobi Security Exchange to ring for the one of the most anticipated listing of the recent time, that is Family Bank. But as an investor, you should be asking yourself this question: should I rush in the moment the trading begins? And this is where most people go wrong. They assume that a new listing can only go up, and that's what I call the first day trap. On listing, excitement takes over. Some rush to buy expecting instant gains, while others rush to sell to lock in profits. Yesterday I did a very good video about Family Bank with all the analysis. Go listen to it. That crash creates volatility. What does volatility mean? It simply means how much a share price moves up and down. On the first day of trading, there is often a lot of uncertainty. Some investors are eager to buy, and I know most of you are there, while others may want to sell once they buy at that 18 or even 19. They want to sell to lock in profit. Even for the existing shareholders, the ones who have the shares now, we don't know. Maybe they can dump the shares. As a result, the share price can swing significantly within a short period of time. And for an investor, this rapid price movement can be confusing and may lead to poor investment decision. If you look at the previous IPO, I don't think we have ever had a listing by introduction. Most of them have been IPOs. If you look at Safaricom, the first day of trading, hype, it went up to 8 bob. But even if you remember, there was a time even it came down to 2.50. KenGen, the first day of trading after IPO, it went up to 40 bob. And that price, currently, it's even trading below its IPO price. So what happens? First day of trading, there is hype, which makes the price to shoot. Then days after, the price can stabilize or it can even dip. The case of Safaricom. But what makes the price to move on long-term basis? That one, it depends on earnings and growth, what I call fundamentals. Second thing, why you should not have this first day trap. It's called emotional buying. When new stocks start trading, many investors experience what is known as fear of missing out, FOMO. They see other people talking about it. Like now, it's the in thing about investing in Nairobi Security Exchange. And worry if they don't buy immediately, they'll miss out in one of lifetime opportunity. The problem is that emotions and investing rarely work together. Buying because of excitement rather than careful analysis can lead to paying more than the stock is actually worthy. The third thing that you should avoid buying on the first day to avoid that first day trap, the market needs to discover the fair value. I've given you the scenario of Safaricom and the scenario of KenGen. Later now, whatever moves their prices is the fundamentals. When a company first starts trading, nobody knows exactly what price the market will ultimately assign it. The first few days or weeks often help investors determine what they believe the company is really worth. Think of it like an auction. At the beginning, investors may place bids based on excitement and expectation. But over time, the price settles close to what buyers and sellers collectively believe it's fair. And that process is called price discovery. We have seen it in Safaricom, KenGen. We can see the KPC share. It's still there at 9 bob. So what should you do as an investor to avoid this first day trap? Patience is one of the most powerful investing tools that I've talked about in most of my videos. Instead of rushing to buy on the first day, consider observing how the market values the company over the following days, weeks, months. Watch how the share price behaves. Then compare that company valuation with other listed companies in the same industry. Then make a decision based on facts rather than emotions. Thank you.